Well, thank you very much for having me. The Carlyle Group manages approximately $200 billion worldwide. Each firm has a different model. Ours is to have funds dispersed all over the world, have people on the ground, a local presence, and then try to take advantage of the global platform we have. As you mentioned, we were the first U.S.-based global alternative asset manager in Africa. We raised about $600 million. We have a very long-term commitment to the area. I thought I'd touch on three quick things. One is the capital raise, which proved to be more difficult than we thought. Secondly, very briefly, what our strategy is. And thirdly, what some of the problems we are encountering or issues as a U.S. domiciled investor. That, first off, fundraising, we found the awareness and the interest was extraordinary. And I'm talking now mainly about institutional investors, primarily in the U.S. Having said that, raising the money proved to be quite difficult. A lot of impediments. How do you do due diligence? The idea that you're going to spread your investments across 4 or 5 countries, the fact that you may be early, and then some of the stories. So we ended up raising most of the money from 2 sources. One was sort of African entrepreneurs and institutions who are very much committed and excited about the region. But then secondly, we found really strong demand from what I would call wealthy families, whether it be family offices or individuals. And finally, through a major bank, we raised almost 40% of the fund through what they call a feeder fund. The bank went to their clients, and again, individuals had a very, very strong interest in that. So we're now up and running with $600 million. We feel that long-term, there will be tremendous institutional interest. But I think first, they want to see a record of investment, particularly with exits, and get more, have the market grow, and just get a little more comfortable with it. So there's an educational process going on, and I think we're very early in terms of funds being committed. As you may be aware, institutions like Cambridge Associates, some of the other consultants, some of the government institutions are all kind of fostering interest in Africa. So we're very early, but very optimistic that'll continue. What we're trying to do is target investments of $50, $75 million or so, well-run companies, et cetera. Let me just summarize that we see no shortage of interest in those deals. They're basically few and far between, and when one comes available, there is a lot of attention. Finally, as a global firm, Washington, D.C., or U.S.-based, we have a lot of challenges that we have to deal with and complexities, and I won't go through them all. I'll just highlight them with the idea that you probably know. Financings are very different than elsewhere. The legal structures are very complex. We have to deal with tax jurisdictions going across a variety of companies. Logistics, again, when you try to deal with companies that are serving a huge continent. And in addition, 2 factors that are a little more kind of pronounced in Africa, one being currency among the countries and the volatility. We've seen that certainly in South Africa, and I think elsewhere it's on the horizon. And then finally, so the whole idea of corruption and whether the perception is worse than reality, I think is a real question to ask, but it is something on everyone's mind. We as a U.S. investor, even though we have our funds domiciled elsewhere, are subject to things like the Foreign Corrupt Practices Act, which can cause you a lot of problems. And how you deal with that is a very, very complicated issue. We have found that the best way for us is to really have good relationships on the ground and be able to check out the people we deal with. That is just of paramount importance. Lastly, I'd say, and others will probably address this, the infrastructure to do deals and provide the kind of services and financings that you need is embryonic. It's at a very early stage, and it can be very, very costly. So having said that, we're very opportunistic. We think that there are a number of deals. We're going to run a concentrated portfolio, and that we're confident that this is a really strong long-term opportunity, both for our firm and for Africa.
Tell me, Ed, in terms of time frame, when an institution like yours has raised $600 million for investments in Africa, what's the time frame in general, on average, if we can ask that kind of question, for really investing the money in terms of deal flows and others? How long does it take, and how does that compare with other regions where you might have been involved in Asia or Latin America?
One difference is that we believe that there are a few really good deals, so we will not run a highly diversified portfolio. But our target would be to put the money to work over, say, a 3-year period. And in our business, to raise more money, you have to return money. So our idea would be to invest over 3 years and return over 5 to 6 years. And people's expectations are in Africa, you should earn a higher rate of return, albeit there's inherent risks. And one of the attractions, of course, is that the world in general is slowing down, and Africa is, I think, going to have 7 of the 10 fastest growing countries over the next 10 years. So growth is a great appeal. I would give one caveat, though. There's been a lot of academic work that suggests there's no correlation between economic growth and investment returns. The real arbiter of how you make money is what kind of price you pay, and then can the company grow.
Doing business in Africa. You can't afford to be without Africa Investor.